even one person, let alone when it has to be a group of people, or obviously in that case, a large group of people. And besides, I think the obvious that people may have seen or felt about what they read about or maybe heard about this particular incident, from my perspective, as someone that helps clients, what I saw is there's some very real lessons there. And for example, one of the audits, Rich, that our company does is one of a company's human resources department. And I think it's really important. And I think what I would take away from that is what, for any company, what are our policies? It's one thing bringing people in. Companies want to hire people all the time, and that's a good day for an organization. But what about when someone does leave, or when you do have to make a decision to let someone go in an involuntary way? How is that handled? And what, do you even have a process? Is it followed? Who is involved in the communication? And obviously we saw that communication is extremely important in situations like this. And so I think, for someone working at a company, that I think is a big takeaway to think about. Well, while we might not do that, what are our processes like, and have we thought of everything? And like to Kevin's point, would it go as smoothly as something like that can go in that unfortunate situation? And are you prepared for that?
Yeah, risk management is more than just hedging a pipeline correctly, right? I mean, I remember my last bank job, we had a chief risk officer, and he could be a pain in my ass at times, but he was a good guy to go to for any kind of situation. And, there was 7 different classifications of risk that he had broken down into this whole like coaching tree type looking document that, let me know as a leader, all the different things that, we had to watch out for as we navigated the waters and ran the company. So yeah, a case study that will be used, I'm sure, in future college courses on not how to handle staffing decisions that are tough as we move forward. So
indeed.
And I want to get into Scott, this recent CFPB supervisory findings, which I found really interesting, as of our members. But before we go there, KP, got the Fed meeting coming up these next couple days. This is kind of a big one in that the wide expectation is that the Fed will formally implement and incorporate new language related to an accelerated taper. Maybe 2 schools of thought. One would be a doubling of the current pace of taper, reduction of bond purchases. Another would be maybe a 50% increase in the taper. Any thoughts you have about the upcoming Fed meeting? Anything you're looking for? Any predictions from the norm? KP.
You want me to give you the my Fed outlook, huh? Wow, this is
Fed outlook.
I hate to use hyperbole, but this is one of the most important Fed meetings we've experienced in a long time, and I really mean that. And I hate, you watch CNBC clips and they're always using hyperbole and they're always saying stuff like that. But this time there's something to it, because we just went through the Fed renomination process. Lyle Brainerd couldn't get the votes on the Hill. They did their little straw poll behind the scenes. Didn't happen. So Jay Powell gets the renomination, and the Fed governors that are leaving are going to get packed with, most likely Biden administration favorable policymakers. That's kind of the idea, is the compromise by not getting Lyle Brainerd on there. And, we had this huge shift that we announced the taper, that we're going to taper. We're talking about taper. Then we said we're going to taper. Then we say how much we're going to taper. And then today and tomorrow, they're going to say, we're probably going to double the taper, which is a big deal. And then when it would separately, besides reducing, from 5 to 10 billion a month in mortgage-backed security purchases, which the Fed owns 30% of the mortgage-backed securities. I mean, they're a humongous buyer. And they're going from 10 to potentially 20 billion a month in treasuries. It's going from 15 to 30 billion to bring that down. Originally thought 1 month ago, by June, now maybe May or earlier, that they'll be done with their quantitative easing. And then separately from tapering and the details for that, what are they going to do with raising the Fed fund interest rate? Are they going to raise it 25 basis points? How soon? Will there be 1, 2, or 3 raises of the Fed funds rate next year? And the calculus has changed. Inflation is no longer transitory. They try to say it's transitory, it's transitory. Okay, well, what we mean by transitory is not permanent. Oh, yeah? No, really? Of course. When you have a multi-trillion-dollar balance sheet, I mean, not permanent for you is great. If I'm working class or a renter or unemployed, worse yet, everything hurts. Everything hurts, whether it's transitory, permanent, not permanent, here for a month, a minute, it doesn't matter, a year or 2. These reads, the 6.8% on the consumer price index, today's freaking 8, like almost 9%, getting up to a 10% handle on producer price index. These are massive, massive numbers. And even if they do ease, even if supply chain constraints do ease, even if demand backs off, it still hurts. And that's a problem in an election year next year on the midterms, when there's a razor thin majority in the House and Senate currently. So we're going to see a massive potential shift in markets. For those of you that are traders and stock, equity, players, like to, dabble in that kind of stuff. You've seen just massive sell-off the last couple of weeks, people tax loss harvesting and positioning themselves for this Fed announcement. There could be a surprise tomorrow. So it will impact our interest rates. It'll impact, what are they going to say about growth? Now, the flip side is retail sales also comes out on the same day. And I did a LinkedIn video about a lot of this stuff last night. And one of the things that I talked about, I heard something over the weekend I'd never heard before. We always hear our economy, our GDP is 70% consumer spending. We hear that over and over and over. I never saw that broken down into, someone said the top 20% of income earners spend 60% of all of that consumer spending, which is 70% of our economy. It sounds like 70% of the time it works all the time, right? But yeah, 70% of our spending is in the GDP and the economy. It's consumer spending, and the top 20% spend 60% of that. They're not affected by inflation. And let's be honest, all of us on this call, we're in that bracket. We're best. We're in the mortgage business. We kick ass. We work hard for it. But are we not going to get a turkey because it's 50 cents more per pound? Are we not going to fill up our gas tank because it's 50 cents more a gallon or even $1 a gallon? Of course we are. It hurts the poor. And that's the voting class. And that's going to be a real problem next year. So I think the retail sales numbers will be strong. And I say this time and again, there's a huge widening of the middle class going on in America. And it just puts even more impetus on us to teach financial literacy and put people in houses.
Well said. And another big inflation number this past Friday, and certainly starting to be more felt on Main Street, public opinion polls. And as you said, KP, one of the most anticipated Fed meetings in quite some time, and certainly the ability to impact our industry as well. So this is a special 12 days at TMC edition of the Last Week in Mortgage Today. I am joined by PRMG's Chief Lending Officer, Kevin Peranio, MQMR's Internal Audit Manager, Scott Weintraub. And Scott, very interesting report that came out last week from the Cfpb, a report highlighting supervisory findings of what they called wide-ranging violations of the law this year.
Isn't it always, right?
In general, the Rohit Chopra CFPB, it's starting to feel very, very much like the old Rich Cordray CFPB, just in terms of their tone. There was this dust up with the FDIC on the disagreement over the bank merger thing. It really, if you're a mortgage lender, it's got your attention, to be sure. After some years of a really defanged CFPB, a lot of the findings that they noted were related to fair lending violations, which, ever since the Biden administration got into office, they've been very open. In addition, all the leaders that they've put in place, talking about the importance of this issue. What were your thoughts? You guys are right in the middle of this, MQMR. Your thoughts on that report of those findings?
Yeah, Rich, it's a great question. And I would just take one half step back generally. The fact that the CFPB puts out this guidance, right, like every 6 months, is part of that is a good thing, right? It's a little bit of them opening up their playbook, and we can see what they're looking at and even what they're finding. And so you're right. I thought the one that came out on Wednesday of last week was particularly interesting. One, it was certainly in alignment with Rich, with what you were just saying, that there's been a huge focus on fair lending ever since Biden took office. It started his first week when he sent a memo to HUD saying, I want you to root out all discrimination in housing, including the mortgage lending process. And so there were 2 points, Rich, I thought that I would raise today for the group. One is on the origination side, making the loans in the first place, there were the fair lending results. And what they focused on, or at least what they put in this particular edition of the highlights report, was focused on pricing exceptions. And that aligns a lot with, it's a big part of what we do when we look at clients. And it's a lot of conversations that we have with companies. Among the things the CFPB found were, if a lender has policies and procedures that allows for pricing exceptions. Some don't even have the policy and procedure. So that would be problem number one, right? But if you have it, are you following them consistently? And equally importantly, do you have the documentation to show why it was justified to make a pricing exception? So for example, if a loan officer comes to you and says, mortgage XYZ down the street can do it for my borrower for an eighth less, so I need us to reduce the rate by an eighth, or we can't make the loan. Well, does the borrower or did the broker, if it was a wholesale transaction, provide you with something that shows that eighth less? Do you have something you can stick in the file that says this is why? It was a competition thing that allowed us to lower the eighth to meet that in order to do the deal for the borrower. And do you maintain that documentation in your file? Another thing they talked about was a lot of companies have sort of a hybrid model for pricing exceptions. There are some levels where you'd have to go to a centralized, like your secondary marketing or cap markets department, to get an exception approved. Whereas other times, loan officers or branch managers have the authority to grant pricing exceptions themselves, either entirely or up to a certain amount. And so that naturally leads to a potential risk for people out there doing different things. And what does different things lead to? It leads to different results. And that's what the CFPB was indicating that they found over the last 6 months, or the first 6 months of the year, that particularly among African Americans and female applicants and borrowers, they were not getting the same results. They were not getting exceptions, whereas more exceptions were being made to the so-called majority group, the non-protected class, white, non-Hispanic borrowers. And so that's what they're finding. And the way to know if you have an issue like that or not is to track your exceptions and report on them, to use the HMDA data that you should be collecting to know who's getting exceptions and who isn't. And so, Rich, that's one part. If you don't know, then you don't know what you don't know, right? And so you don't know if you have an issue or not. The second thing I wanted to add is they also talked about the servicing side. And so that obviously you can get in just as much trouble on the servicing side with the loan as you can when you're making the loan in the first place. One of the things that I found really interesting that they found on the servicing side was they found servicers who were not evaluating loss mitigation applications in a timely manner, meaning within 30 days of when that loss mitigation application is complete or deemed complete by the servicer. And that obviously has real consequences for a borrower who's hopefully trying to stay in their home. And I now go back, Rich, to something the CFPB has said more than once when new laws have come out. They made this comment right back when COVID hit, that if a servicer is making, quote, good faith efforts to comply, they might not enforce things as strictly if they found errors. It's not the first time they've said something like that. And then also what happened, not for the first time, is that when it actually comes time and they come out and audit companies, they will hold them responsible. And so what you saw in this supervisory highlights report is the servicers told the CFPB, you know what, this was COVID times. We got an explosion of forbearances, people having trouble. Our vendors, upon whom we rely to provide us services, they were backed up and slow. We didn't have adequate staffing. How could we have in such a short time? And the CFPB basically told those servicers that wasn't good enough. And you weren't making good faith efforts to comply. Almost the opposite of what they said at the beginning, right? You ought to have added more staff. You ought to have done something about your vendors or whatever to take steps to make sure your borrowers weren't harmed. And as that report indicates, now the servicers are having to do that and make it any other remediations that may be going on with that company in particular. So I think the lesson is what the regulations require, that's there in print in black and white, isn't it, Rich? Even if the CFPB says we may or may not enforce, the best plan, and this is, I think, what we try to help our clients understand, is the best plan is if there's a law or a reg out there, you know you're going to be safe if you comply with it, right? Whatever that means. So, and I thought it was a big week, as Kevin said, a big week, obviously, with the market, but a big week whenever those highlights reports come out. I'd only add, Rich, that's not the only way the CFPB gives us information. They put settlement agreements on there as well. And to your point about fair lending, there was one recently with a bank, although I think they would apply the same standards to a non-bank in some sense, which is marketing. That's a big part of fair lending as well. And are you marketing to your consumers in a way that it encourages everyone to apply, or in the jurisdictions where you do business? So a lot out there, Rich, from them.
Yeah, they're clearly leaving a trail of breadcrumbs. 3-4 weeks ago, they came out and said, hey, the CFPB came out willingly and said, listen, we are really examining all this HMDA data we're sitting on and the ways that we can use it to, try to find bias in lending. Then they come out with this supervisory report. Let's not forget Rich Cordray, when he was in the position, he used that position in a very aggressive tone as the leader of it to catapult himself into run for the governor of Ohio. I've heard through the grapevine that Rohit Chopra, a very aspirational politician as well. So you got some young, up and coming politicians leading this division now that are going to be very serious about achieving the results that they want to through it. Consumer protection is a very populist topic as well. So something to keep an eye on. And KP, PRMG, you guys are all 3 channels. You guys are all 50 state. Take us a little bit inside, your mindset as a leader, how you're just managing this issue, things like tracking exceptions. And I know you guys have been out in front of this and doing a lot of this stuff before the change in administration, but just would be curious as to your insight on this emerging topic in the industry.
Well, I think we have some good ground tactical insight to offer to the rest of the collaborative. We just went through a CFPB audit. It was our first one, and we had no findings. A couple things here and there, but what's interesting is there's a handful of lenders that are in the middle or have completed and gone through what would normally be the entire process. And now that it's over, they're like, okay, hang on. We need to figure out who's running the show here. We have no idea what's going on back in DC. So literally the CFPB, there's some people that have been there, since inception, and they're kind of like the ones, the auditors that are doing the stuff, and they're very cool. But now they're waiting for guidance and direction from leadership, which just got nominated, who's then trying to fulfill and fill all the other leadership positions, and then kind of set their agenda, who they're going to target, what they're going to target, how they're going to target. They've got this data. They've got people like us teed up and ready, to engage with on whatever topics that they want to prioritize, which many of them we just mentioned. So that's kind of where we're at. So they're in a little bit of a holding pattern. On a separate note, we beat our False Claims Act, which was cool. And I think, our attorney, the representative, said his last 29 clients in a row all got fined, and Department of J kicked it back and said, hey man, Department of Justice says there's no there. So you guys are good. So, and then I think goes to, self-reporting any defects with your loans. I will tell you, the fact that we self-report on our HUD loans, if we have loans that are uninsurable, we say we have a loan that we think is uninsurable, we try and work through it. We're open, honest, and transparent about it. I think that's what helped us with the False Claims Act. And if you take that same mindset with the way you do origination, and LO compensation, and your HMDA data and your reporting. I mean, gosh, for the last 3 years, we've just been hammering our HMDA reporting to make sure that we've been getting caught up and more accurate and have less defects and bringing that, flatten that curve of defect percentage. We're very lucky. Mark Ely is our general counsel, who we brought in a couple of years ago. He used to be at Finance of America, and he'd already been through a couple of these audits. Main reason why we brought him over. He didn't want to work for the big the big equity firm machine. And, he liked our vibe a little better. And we had a guy that was kind of a novice and really unorganized. Won't say any names, but he would have just got crushed in an audit like that. So we just got lucky. The timing came up with all of us, and here we are. So I think if you do the right thing by the consumer, I don't think you have a deal killer coming your way from the CFPB. But it's like regulators. I get it. Like, they want to protect the consumer, and I'll just contend, like I always do. Tell us what you don't want us to do, and then we'll all go fix it. Like today, like right now. Like, just tell us right now what you don't want us to do, and we'll all go fix it. Nobody wants a fine, but they don't. If you're going back to the gotcha thing, like you had with Cordray, which is an awful way to be a partner with the lending community that's serving the underserved, by the way. I mean, it's like, we're the independent mortgage bankers in the communities, rooted in the local communities, doing the work the Biden administration wants, serving the underserved. So you're going to play gotcha with us? Help us help you. So right. I think they need to kind of get some alignment with what they want the CFPB to do versus actually achieve their housing goals, and it's not going to come from creating a gotcha environment. And Cordray lost, by the way, in Ohio. So
Get the wine. So, and such a great point about, self-reporting and self-identifying. I remember going through these things on the bank side, and that is such a big part of it. Like PMG, you guys are, able at your size to be able to hire internal counsel. But one of the reasons we wanted to have Scott on is a lot of TMC members, smaller independent mortgage banks, community banks, credit unions that, they don't have an internal audit department or an internal counsel. And it is really so important. I know Fannie and Freddie are now mandating it, Scott, to have some sort of internal audit function that is willingly analyzing your organization, looking for defects, looking for, deficiencies and things that you need to fix, and being proactive about addressing them, as opposed to the regulators finding when they come in. Right, Scott?
You're absolutely right, Rich. And I would just say, what happened, Kevin, at your company doesn't happen by magic, right? Or luck. You mentioned maybe there was some luck in the timing, but the results of your CFPB exam were not lucky or magic. Right? It was a lot of work, I think, that you and your colleagues put in. And you're right, not everyone has the resources, Rich, to do that internally. That's exactly why MQMR is here and how we can help clients. And our goal is obviously, it's the opposite of gotcha, right? As Kevin mentioned, it's the opposite of that. It is to help our clients. And by help, I mean, we want them to be exam ready. We want them, when the CFPB comes out, or a state regulator, we want them to get the Kevin treatment, right? We want the no findings. And by one of the ways we can do that is by getting them prepared. If there is anything to find, we're going to find it. And we're going to make suggestions and help them work through those things and get their operations to be even more effective than they already are, right? Like I mentioned earlier, we go through every department that an organization has. And that's really important, because you don't know necessarily where your risk might be coming from. And that's what we can help with, right? To know where your risk is coming from so you can be prepared when those audits happen.
Yeah. And anybody that is not doing business with MQMR or needs help getting connected with them, just reach out to me or anybody on our team, and we can do that. But as always, the time flies by. We're at the end of our half hour, and we've got industry titan Teresa Bryce Basemore as our keynote of the day that is coming up in 1 minute. And somebody from our team.
She is so awesome. I saw her a few years ago the first time. She's amazing. She's done a lot in this business. She's really cool. So
for sure.
Yeah, we've been trying to get her to speak for years at things we've done, and luckily for us, she agreed to do it. So that's coming up right now. But KP, as always, thank you very much. Always appreciate your insight, brother.
Thank you. And cheers, Scott, everyone. Happy holidays.
Happy holidays. And Scott, thank you very much. MQMR, 5 years now, a TMC partner, and a lot of happy TMC lender members, and you guys have done great work for the network. So really appreciate you and MQMR.
Appreciate that. Thanks, Rich. Kevin, thanks for letting me be on with you. Happy holidays to everybody.
Happy holidays, everyone. Take care.
Take care.
Bye. Cheers.